The UK property market is currently operating on the assumption that borrowing costs will continue to fall. After the disruption caused by Liz Truss's mini-budget in 2022, which pushed mortgage rates above 6% and brought market activity to a halt, rates declined steadily through 2024 and into 2026. That decline accelerated in recent months as lenders entered a period of intense price competition. HSBC, Nationwide and Barclays have each reduced rates multiple times, while some smaller lenders now offer rates as low as 3.4% for borrowers with deposits of 40%. These changes have materially altered affordability calculations. A £300,000 mortgage at 6% costs roughly £2,000 per month. At 4%, the same loan costs about £1,400 per month, a difference of £600 monthly or £7,200 per year. This shift explains the sharp increase in buyer demand. Financial markets are currently pricing in a base rate of around 3.25% by the end of 2026. That expectation is embedded in mortgage pricing, property valuations, buyer behaviour, and lender risk models. Estate agents are advising buyers that borrowing costs are likely to continue falling. Sellers are setting asking prices based on improved affordability. Developers are planning projects on the assumption that demand will remain strong. From individual buyers to institutional investors, decisions are being made on the basis of this projected rate path. However, expectations are increasingly diverging from the underlying policy environment. Recent communications from the Bank of England indicate significantly less confidence in continued rate cuts than financial markets currently assume. If those expectations are not met, the resulting adjustment in the property market would be immediate. The Bank of England's ability to cut rates depends on inflation remaining under control, and inflation has proven more persistent than anticipated. Headline inflation has fallen from levels above 10% in 2022, but core inflation, which excludes food and energy, remains elevated at 3.4%, well above the bank's 2% target. Service sector inflation is particularly concerning, standing at 5% as of January 2026. This reflects wage growth feeding through to prices across a wide range of services. The bank has repeatedly stated that core and service sector inflation are central to its rate decisions. Both indicators suggest that inflationary pressures remain entrenched. Average wage growth across the UK economy is running at approximately 5.2% annually. While higher pay has followed years of declining real incomes, it also increases business costs, which are passed on to consumers. This dynamic risks creating a wage price spiral that limits the scope for rate reductions. Fiscal policy adds further complexity. The Labour government's budget included significant increases in public spending, including higher public sector wages and major infrastructure programmes. The Office for Budget Responsibility estimates that these measures could add around 0.5 percentage point to inflation over the next 2 years. While such spending may support long-term growth, it adds demand to an economy already under inflationary pressure, reducing the room for monetary easing. This creates a structural tension between fiscal expansion and monetary restraint.
The Bank of England also operates within a global context. The US Federal Reserve has signaled that it expects to keep rates higher for longer as US inflation remains persistent. If the Bank of England were to cut rates aggressively while the Federal Reserve holds steady, the pound would likely weaken against the dollar. A weaker pound raises the cost of imports, particularly energy, food and manufactured goods priced in dollars, directly feeding domestic inflation. Global trade policy further complicates the outlook. Tariffs and trade restrictions introduced by major economies have increased costs across supply chains. The UK's post-Brexit trade arrangements remain unsettled, with ongoing negotiations affecting sectors ranging from agriculture to financial services. These uncertainties add inflation risks that constrain monetary policy. Energy prices also remain volatile due to geopolitical tensions and supply disruptions. Although prices have fallen from their peaks, they remain elevated and subject to sudden increases, affecting both household bills and business costs. Current property prices and transaction volumes depend heavily on the expectation of continued rate cuts. If those cuts fail to materialize, or if rates rise again, the impact on the housing market would be rapid. Many buyers are stretching affordability limits based on the assumption that refinancing in 2 or 5 years will be cheaper. If rates remain high, borrowers who can manage payments at 4% may be unable to do so at 6%. This creates the risk of forced sales as households struggle to refinance or maintain payments.
The market experienced a similar dynamic in 2022. Following the mini-budget, transaction volumes fell by nearly 30% within months. Sales collapsed as buyers lost mortgage offers or could no longer afford agreed prices. Estate agents reported widespread chain failures, and some buyers who had already sold were left in temporary accommodation when onward purchases fell through. The current recovery has recreated some of the same vulnerabilities, with longer chains and higher leverage increasing systemic risk. Regional impacts vary significantly. London and the southeast, where prices are highest relative to incomes, are most exposed to changes in borrowing costs. Small increases in rates can remove large numbers of buyers from the market. Northern regions and Scotland have lower price-to-income ratios, offering more affordability headroom, but they also face weaker economic conditions and slower wage growth. National rate changes, therefore, affect regions unevenly, increasing the risk of a fragmented market. Buy-to-let investors face additional pressure. Mortgage rates for investment properties typically sit 1 to 2 percentage points above residential rates, leaving many landlords paying 6% or more. Rental income growth has not kept pace with higher financing costs, and some landlords are operating at negative cash flow. Elevated rates may push more investors to exit, but high borrowing costs also limit buyer demand, creating a standoff that suppresses transactions. Market psychology plays a significant role in these dynamics. Estate agents report that while viewings and inquiries have increased, serious offers remain below previous peaks. Many buyers are recalculating affordability and recognizing that their decisions depend on further rate cuts. Some are delaying purchases until policy expectations become clearer. Sellers, meanwhile, are pricing properties based on recent sales and optimistic forecasts. If demand weakens, they face the choice of lowering prices or withdrawing from the market, both of which reduce activity.
Media narratives amplify these shifts. 18 months ago, coverage focused on falling prices and market stress. More recently, headlines have highlighted rising demand and price growth. Such narratives influence behavior and can reverse quickly, altering market sentiment within weeks. Risks are unevenly distributed. Buyers who entered the market in the past 6 months based on expectations of continued rate declines face the greatest exposure. If rates fail to fall further, these households risk negative equity or refinancing difficulties. Lender stress tests are designed to mitigate this, but they assume stable economic conditions. Prolonged periods of high inflation and elevated rates challenge those assumptions. Cash buyers are less exposed to financing risk and may benefit from price adjustments driven by affordability constraints. However, they also face downside risk in an illiquid market if prices fall after purchase. First-time buyers face particularly difficult choices. They are often encouraged to buy quickly, yet they typically borrow close to their maximum capacity with limited deposits, making them more vulnerable to rate increases. Some are choosing to wait, reflecting concerns about market stability. Homeowners with substantial equity and low fixed-rate mortgages are better insulated and can delay transactions. Those who must move due to personal or professional reasons, however, remain exposed, regardless of broader conditions. Underlying these cyclical dynamics is a long-standing structural issue. The UK consistently builds fewer homes than required to meet population growth and household formation. Around 220,000 homes are added each year, compared with an estimated need of at least 300,000. This shortfall has accumulated over decades due to planning constraints, land availability, infrastructure limitations, and construction capacity. Monetary policy cannot resolve these supply shortages.
Supply constraints are most severe in high-demand areas, such as London and the South East, which also have the most restrictive planning environments. Northern regions face weaker demand despite relatively better supply. This imbalance limits the market's ability to adjust without significant economic or demographic shifts. Without a sustained increase in housing construction, particularly in high-demand regions, affordability pressures will persist. In the near term, falling mortgage rates have improved affordability and released pent-up demand from buyers sidelined over the past 2 years. Transaction activity is likely to remain elevated through spring 2026, with prices rising in many regions. However, this recovery is dependent on assumptions about future interest rate policy. The Bank of England faces competing pressures from persistent inflation, fiscal expansion, global conditions, and currency dynamics. If expected rate cuts do not occur, or if policy tightening becomes necessary, the current upswing would reverse quickly. The UK housing market in 2026 therefore sits at a point of heightened sensitivity. Outcomes depend heavily on interest rate decisions that buyers and sellers cannot influence. Market participants are effectively making leveraged bets on the direction of monetary policy, with limited margin for error.